Now I'm recording.
Can you see my screen?
Yep.
Sweet. All right, and let me bring up the chat window so I can look at what people are typing. All right. So today's topic, right, guys, is about stop losses. Now, in this market, the way this market is trading with all of this chop, it's highly important that you keep good stop losses in place, right? Now, stop losses could be anything. And why I say anything is because different people have different account sizes, different risk tolerances. For some people, a 10% loss is pretty tough, and for some people, a 50% loss is pretty tough. So it all depends upon what your risk tolerance is and what you can actually afford, right? So that is why usually what I do is the way I trade is I'll add to my winners. So let's say if I'm entering a particular position and that position is going in favor, expecting and it's doing what I expect it to do, then what I do is I basically add to that. I scale in, I add more contracts and let it ride up. Number one. So in that case, what happens is, so let's say you enter a position right off the bat with just one contract. Okay, just hypothetically, let's just assume that that's what you're doing. When you enter with one contract and that ticker actually reverses against you, and let's say you spend $100 on that particular in a contract, and you have a 20% in a stop loss, at the most you're going to lose on that position is only about $20. Now, if you enter if you decide oh, you know what, I'm going to play 5 contracts for something, for Facebook or for eBay, any ticker, and you go in in a heavy, you buy in a 5, 10, 15 contracts, and something happens and it actually reverses against you, what's going to happen is, even though you've kept a 20% loss, a 20% on those 5, 10, 15 contracts combined could be a pretty significant amount. So that's the reason why what I like to do is, when I start right off the bat, if I'm going to trade something, I'm adding to my winner. So that I'm risking a very minimal amount if that has to reverse against me. The other thing is, now if you're scalping, obviously you're basically trading right off a candle or two, maybe on the 1 minute, or maybe on the 3 minutes, or maybe on the 5 minutes. You're not holding for that long. And when you're going in heavy, you're in and out so quick, it's hard to actually determine what your stop loss is going to be. You see a little red because you're heavy in that particular position, you might just cut it off. But to calculate in that fast paced process, as you're trading right off the open, it's kind of hard to actually pick your stop losses. So that's why more so for day trading, something that you're going to hold for an hour or 2 hours or throughout the day, or even for for swinging a position, stop losses would make sense, because you can have a clear cut, well defined stop loss in terms of what that amount should actually be. So determine what you're trying to do, what sort of trading you're doing, whether you're scalping, whether you're day trading, or whether you're actually swinging, and then plan your stop loss accordingly. And as I said, that could be 10%, that could be 20%, that could be 50%. It all depends upon how much breathing room you want to give the stock to do what you want it to do, or how much risk tolerance you can basically afford on any particular contract that you actually choose. Now, usually what happens is, every night when I'm sitting and chatting and I'm marking my levels, for making a particular trade, I'm determining like, okay, at what point am I entering? At what point am I going to either start taking profits or maybe adding to like, to my position? And at what point I'm supposed to basically cut it off. Now let's just assume eBay, right? Forget all of this that is like, let's just assume like eBay is today somewhere over here. What I'll do is I'll come in, I'll mark, sorry. I'll come in, I'll mark my entries, my exits for what I'm actually going to like, want to trade. So let's just say this is going to be my entry. So I'll mark down like, my entry over here. This is the entry level, and I'll set up like, my alerts for eBay for that particular level. I'll mark what my exit is going to be. Target or add to position at this particular point. And then what I'll do is, if I could keep a pretty tight stop loss on this particular like in a contract if I want. So let's say if I enter somewhere like over here, what I could do is I could mark the center of this particular candle, whatever my entry is. Maybe I'll mark that and keep that as my stop loss, that you know what, no matter what happens, if this guy reverses against me, and if he's going to like, if he's going to retrace and go back down, most likely he's going to try and take out the low, because this is like, this is a consolidation on the day. So if he's unable to break and continue up, he's going to come back down and he's going to try to like, to break the low of the day. So I'll mark like, a clearly defined stop loss. So what happens is, when the day opens up, and when like, when my alerts go off, like, I'll set my alert over here, like I'll say create alert, let me know eBay is like, at up or above 58.34, and I'll create like, that alert. Obviously it went off because eBay is way above 58.34, but you'll see an alert like, show up over here. So when that alert goes off, I come to like, eBay, I'll take a look and see what's actually going on the smaller time frames, and I'll see these levels that are marked over here. Here's my stop loss. Here is like, if I'm going to go below, this would be my entry for puts. So I'll clearly mark these. So when I'm looking at the charts, I'm not trying to figure out like, okay, what are all these levels? What do they actually mean? So like, what? So then I'll hold them over here. I'll mark my entry. Now I'll come like, to the 5 minutes. So let's go like, to the 5 minutes. This I think was like, when they fill the gap. So let's pick around like, 20 days, for example, right? Now, when you're going back to the levels, like, I believe this, it was one of these days over here. I'm trying to figure out which one it was. Right here, let's just say like, let's just say this was the particular day that I'm actually like, trading. So this is on the 5 minutes, right? So what I do is, when the alert goes off, I'm coming to like, to the 5 minutes, and I'm going to try and time my entries. Now eBay had a big gap like, to fill. So I had already like, in my mind, I had already decided like, okay, if eBay keeps running up, right, on my larger time frames like the weekly and monthly, eBay is green, which means buyers are in control. So it very well could like, go and fill that gap, because like, buyers are going to keep pushing this stock up. So I'll already keep that like, mentally in my mind. So I know like, okay, if eBay comes over here and then I see big heavy selling, I'll probably like, like, okay, I'll take my gains, and then I'll probably re-enter the position at a later point of time to try and see if it can like, if it can fill that gap, right? So but you see, here's my stop loss like right over here. So if I'm getting into a position, and let's say if that position reverses against me, okay, I'm waiting for it to come to the stop loss where it's not, nothing is happening at all. Yes, it comes back, it pulls back, but it doesn't go to the level that I'm actually like, expecting. So I've given it a little bit of like, breathing room, like 58.33 to about like 57. So I've given it like 60 cents of breathing room for the stocks to like, to do what it needs to, and continue its push up. Because if you keep your stop loss too tight, then what happens is more than likely you're going to get stopped out, only to come back and see that the stock ran up and did exactly like what you wanted it to do. So I've given it a little bit of breathing room here, right? And then I always profess, okay, you do a break and hold, a break and hold. What does that break and hold actually mean? So over here, yes, it's a little tight because it's only about 50 cents, and eBay really went right off the bat. But if this was if this was a larger percentage, what you could, or a larger gap between the entry and the target, you see, once this breaks, most likely this candle, even if it opens up in a red, you want to see that it does not pull back to your entry level. If it does pull back to your entry level, then at that point of time, because if you rushed over here, this was just the break, there is no hold yet. You want confirmation for the next candle to hold above your entry trigger, because that's when it tells you okay, you're good to go in order to to buy calls and go long on the position. So if this guy had to reverse against you and come back to the entry, you see, that was perfect because it hasn't held yet. If this was green and continued and continued up, that's when you'd be like, okay, that's my hold. So now I can safely enter enter a long position. uh, Let me see if I can find a better day for let's take this guy. Here's the entry, and let's just assume this guy is going to be your target. Forget about the other day. This is there's a clear a nice decent decent size movement over here. So let's just say this was your entry, this was your target. Now this breaks, and you see the next candle right off the bat, the second candle goes above. It's not even reversing back on you. There are buyers straight up, they are pushing the stock, so this level is holding. At this point, enter your long position. Let's say you enter at 58.45, and 58.65 is going to be your target. Hold through. Now you've entered over here 58.45. Let's mark this level over here as your entry. Okay, you've entered at this particular point. Now this is your break even essentially. You see the stock, it keeps going up. Now you see this big red, and now you get jittery because you're like, oh crap, this is going to reverse against me now. I should sell it over here. Well, yes, you could. You've secured some gains from 58.45 all the way through about 52 58.62 for eBay. This 17-18 cent move is a nice 20-30 dollars on a contract. So yes, you've made some money. But you see this red candle, it did not come back to your break even. It did not come back to your entry, because if you had to hold through this red, and even if it pulled back on you, the worst that could have happened is you get out at your entry for at break even. And then you just wait and see what happens. If eBay then reverses once it breaks down and goes below, or if it if it decides to just keep the dumping. But at least you got out at your break even, so you've not lost any money on your contract. But see, never happened. eBay stalled over here, and then it continued its push up again. So here now it reached its target of 58.65, and you're good to go. So you've basically reached your target. At this point, you can secure your gains. This is assuming that there is no gap. As I said, I picked eBay because I saw the gap. I knew, okay, there's a gap. Buyers are there on the longer time frames. They're going to try and push this up. So I said, okay, I've marked my target over here. And then at this level, I basically watch to see what happens. If it can sustain its momentum, or if it decides to pull back. And then I start seeing, okay, eBay is pulling back. It's not really this is just chop zone, and then it starts coming back down. So over here, if I have multiple contracts, you could trim and just let a few ride to see if it'll fill that gap, either the same day or the next day or whenever it is. Or you could sell your entire position and then re-enter at a later point if if you want. Now I'm looking at the 5-minute time frame, so obviously there's more there's more noise on this 5-minute time frame, but it should give you a clear-cut idea of why it's necessary to mark your levels and why it's necessary to give some breathing room for the stock to to do its thing. See, you entered over here, you keep that as your break even, you just ride it through till it till it hits your target. Now you say okay, let now you've entered the position and you're what, I'm going to try and ride this through and see if it can if it can go beyond what its daily target is, and let's see if it can try and fill that gap. So then what you do is, after you've entered your position, let's say you decide, okay, I'm going to trade I'm going to watch this under 15 minutes. A few weeks back I had mentioned something about a Heikin-Ashi candle. Okay, so if you change your candle over here, like when you go into TOS, you change you go to candle type, or I'm sorry, chart type, and you change it to Heikin-Ashi. Look at what the Heikin-Ashi looks on the 15 minutes. And I found 15 minutes to be the sweet spot for the Heikin-Ashi. Okay, so you enter somewhere over here, you're riding this all the way through. You're not getting shook out at all, because you see it's just green straight up. All right, you're holding it all the way through. As soon as you start seeing some red over here, get out. Like you've taken your profits, it's gone past your target. What more do you want? You've secured gains, you've hit your target and then some. So you see a little bit of red over here, it starts pulling back down. Take your gains, secure it, and and walk away, and don't even look back. So the Heikin-Ashi is one of the ways where you can set your stop losses also, where when you see a red on the 15 minutes, you can basically take your gains and walk away from it. That's the second thing. Or as I said, the first one would have been, you just let it come back to your entry and break even. eBay would did not okay, like eBay failed, it only went up to over here, let's say this particular level, and it pulled back down. You get out at break even, no loss on the contracts, which is which is just as good. You did not make money, but the better thing is that you did not lose money. And that's why it's highly critical that you you mark your stop loss at break even. Now let's assume okay, you decide not to do anything of anything of that sort, and you're what, I'm going to keep riding this as much as I can from and try and secure as much profit as I could. So let's assume here's your entry over here. On every single candle, another stop loss that you can keep is the bottom of the candle. So when this runs up, now your new stop loss is going to be this guy. He continues running up, now your new stop loss could be this particular candle that you could keep. Over here you could have this guy as your new stop loss. You get rid of get rid of these, get rid of this, get rid of this, and now this the bottom of this candle is your new stop loss. And then over here at this particular candle, you keep once that candle closes, you keep him as your stop loss. So you've rode everything all the way from over here to about 58 97, a good 50 cents. That is actually a $40-$45 move on eBay contracts. And once you see this red and it starts breaking down and hits your stop loss, which is the bottom of this candle, sell it. Doesn't matter what the stock does past this point, you've secured gains, and that's all that matters. Nobody goes broke by securing gains in in this market, especially in a market like this where everything is just basically consolidating, not really moving up or down much. It's just chop 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 the entire time. So whatever you can get, take it. Let's assume you didn't do that. You're greedy, you don't want to you don't want to sell, you want your contracts to hit 100%. But then see, if you didn't have your stop losses, sure, eBay pulled back. At this point over here, you would have been in losses. It moved up a little bit, you gained maybe $5 or $10 or so, again it pulled back, and then again it went up over here. At the most, you would have you would have made some money, but then all of this would have got you worried, oh man, I should have taken my gains, I should have cut my contracts over here, I should have taken my profit. And you should have and you should have basically just, when you could have secured it, you would have been oh crap, I was up 40%, I was up 50%, why didn't I take my gains at that particular point of at that particular point of time. So you see that it's important that you clearly define. For different people, there are different strategies. As I said, first thing is, you enter a position, all right, and you keep a 15 to 20% stop loss. Let's say you're being very like tight, very conservative. You keep a 15 to 20% like stop loss in order to like so that if the position goes against you, then you're getting out. So you enter over here, you calculate 15 to like 20% is going to be maybe $10 on this particular like contract. If it doesn't reverse against you and if it keeps going up, then yeah, then shift to the bottom of every like every candle, or keep like your entry as the break even. So even if it reverses against you, you can pretty much like get out at that point, or once it hits your target, secure your gains. That's another way to do it. Some folks, what they would like to do is they would add the EMAs. Now what I found is, at least back in the day, right, let me add the exponential. Okay, so there is a 9, there is a 21, and then there is the 55. The mid EMA, which is like which is the 21, a lot of folks like to use that as the like as the break even, where once a stock runs up and if it pulls back, once it hits that 21 like EMA, they're getting out. Some people like to use the 9, some people like to use like the 5, I'm sorry, the 55. That's fine too. It all depends upon what's the sweet spot for you. No, Ron, Heikinashi doesn't work for swings. Heikinashi is only on the 15 minutes. It would just be for like for day trades. So either the 9, the 21, or the 55. That's one way to use like and set your stop loss according like according to that. That once the stock runs up and it pulls back, you get out once it hits that particular EMA. As I said, I just mark my levels once like once I'm in green, and once the position is going like in my favor, then I'm just keeping my stop loss at the bottom of like the bottom of every candle, so that if it reverses against me, I can get out. I mean, like how much more do you want to milk, right? You don't want to be greedy. You want to take what you can actually get. So that's another way to do it too. So just a rehash. Number one is, as soon as you enter, if it goes back, if it goes against you, a 10 to 15 like in a percent stop loss. Let's say you get stopped out somewhere over here at this bottom, and then eventually you see you're waiting, maybe middle of the day, this like like all of this happens, it pulls down, and then it starts breaking over here. Like, see, this is somewhere around like 2 o'clock in the afternoon Eastern time. This could be your entry again, because you see a break, you see a hold of that trigger, and you can play this. Does not always, tickers do not always have to be traded at the beginning of the day. There are movements that take place during the day too. You can always come back. If the setup is still valid, you can always come back and like trade it again. So number one, right off the bat, 10 to 15% like in a stop loss. And the second thing would be, what you can do is, as the position goes in your favor, every single candle you mark like the bottom of that candle to be your like your new stop loss. So if it reverses against you, then you're getting out like in gains. You're not losing any like any profits at all. You're still securing like some gains. Number three is, you can keep your break even. If you decide you want to give like some breathing room for the stock to do what it needs to, keep like keep your break even, your entry point, as your stop loss. So let the stock like go up. Let's say it only went up to here, it pulled back like somewhere over here, and then it decides to run up. At least you have your break even. So worst comes to worst, you get out with like with zero loss, zero profit, and then you can re-enter always if like the stock is doing what you want it to do. And the last thing that you would do at that point is the sorry, one second, a little later, baby. So, and the other thing is the Heikinashi candles, right? So if you have Heikinashi set on the 15 minutes, once you're seeing green, 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 you see a red, you sell it. Or if you're in puts, you see red, 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 rode it all the way down, and then you see a green, sell it at that particular like in the point and take your gains. For puts also, it would be the same exact thing. You mark your levels, which would become like the top of every candle. That would be a new like stop loss. And then so when it comes down, you look at it like over here. Once it crosses that level, you're done like green. So you secure as much profit as possible from your contracts, and you're good to go. Now there is one more way to actually automate this and do this if you've not if you've not done this before, and that is by setting it so let's assume the 15 minutes is your sweet spot. So take note of this and see how it's being done. One of the current contracts that I'm in is ET. Okay, so the position that I'm in is my January 2023. So what you do at this particular point is, right, you can actually, so let's say you're in a particular position for the day. Now, I think who it was, I think it was Trey or someone had asked okay, how do I automate this if I walk away? Now, you decide how much of a tolerance you have, whether you can tolerate it for 15 minutes, for the 30 minutes, and for the 1 hour, if you can afford to hold something for for that long. And why I'm saying that is because you can actually set a trailing stop based on what a candle does on a particular time frame. So let's assume I decide I'm going to sell my contract. I'm up, I'm green on the contract, and now I want to I wanted to exit once it hits a certain threshold, because I have to go to work, I've got a work call, I cannot actively manage it. All right, so when you create your sell order, you see on the right over here there's a small little gear icon. You click that. All right, it'll bring this up. It'll say sell 1 ET, blah blah blah, sell size. Over here right in the middle, okay, you click over here, automatically ET will come up. Click on the method and say study, edit. When you click edit, change the time frame to whatever time frame you want, whether it's a 15 minutes or whether it's a 30 minutes or whether it's a 1 hour. I usually like to do this on the 15 minutes because with the hourly, it's so long, and things in this market, things could go against you so quickly within an hour. So 15 minutes is is the sweet spot. So what I do is I do 15 minutes, delete the default over here, add a condition where you say the price. Now let's say you're in calls. Okay, so obviously you want to get out of your calls once the ticker starts reversing against you. So you would say the high is less than the high from 1 bar ago. Okay, click save. It'll say high is less than high from 1 bar ago, and this is going to be on the 15 minutes. You click OK, you click save, and you do confirm and send, and you send the order. All right, so you would do 15 minutes. It again, what it would look like is high from, it's going to be a study, high from high is less than high from 1 bar ago. What that looks like on this particular time frame, let's take the 15 minutes over here, for example, right? So let's say you entered you entered the position over here. All right, somewhere over here is where you made you made your entry. Let's just assume this was your trigger, and somewhere over here was your target. When you when you set up that study where the high of the current candle is less than the high of the candle previous to it, you see, you enter over here, you set your trailing stop, you're green, now you set your trailing stop. You see, this guy keeps going up. Yes, you could have potentially gotten stopped out over here, all right, because this candle closed less than the high of the previous candle. But otherwise, if this did not happen, what will happen is you would run this all the way up to over here, because let's assume you entered you entered over here, for example, you entered at this. All right, you see high, 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 high. So every single candle on the 15-minute, as long as that high is not less than the high of the previous candle, it'll pretty much keep you in the trade and then stop you out once once that candle closes below. So over here, you would have probably gotten stopped out at this level, because you see the high on this 15 minutes was less than the high of of this particular candle. Does that make sense? If you have any questions, just post it in the chat. I'm watching the chat also. So it was going to be the high of the current candle. If it's less than the high of the previous candle on the 15 minutes, it would basically like, close out your position and take your gains. You could set it up on the 30 minutes too. All you have to do is you would just have to like, you would just have to set up the time frames accordingly, like, which day, which like, time frame you're more like comfortable with. If the 30 days is what like, if the 30 minutes, sorry, is what like, works for you, then okay, then like, keep, then trade it on the 30 minutes. If you can tolerate the hourly, then sure, do it on the hourly. It doesn't matter which time frame. You've just got to pick what your comfort, like, what your comfort level is. Same thing, if I was doing this on like, let's say for puts, the exact same thing that I would have done is, for the put side of like, setting my trail stop, is I would go to the gear icon. I would say like, ET, go to study, edit, change this to the 15 minutes, delete this, and add a condition where the low is greater than the low from 1 bar ago. So the low is greater than the low from 1 bar ago. Because obviously, if you're going, if you're in puts, then what you want to see is like, lower lows, candles that are low, 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 and then like, eventually when it reverses, that's when you're going to have a high that's higher than the previous like, candle. So that's how you would set it up. Low is greater than low from 1 bar ago. Click OK, click save, confirm, and send the order, and then you'll see a mark on like, on your ticker. So when you're at this point, let's take this particular day. So you see, if you had to like, if you were entering puts, let's say this was your entry and this was your like, supposed like exit for that particular day. If you entered somewhere around over here, you see, and if you set it on the 15 minutes, this guy right here, yeah, if you set it on the 15 minutes, you see, you entered somewhere over here. This is the 15 minutes. Obviously on the 5 minutes you would have went like, the candle would have been different. So you would have entered, held it all the way through over here, and then see, once this guy, the low of this guy is higher like, than this, then you would have, it would have basically like, cut you off like over here. See, the low is higher than this particular like, than this particular guy. This low is over here, 9.71. The low of the previous candle is actually 9.69 or 9.7, like, around that. So when this low is higher and it closes above this guy, you would have, your contracts would have like, sold, and you would have been like, you would have been done with it. So that's how you would actually automate your stop losses, where if you can't manage a position, then you just want to like, once you enter, once you go green, set a trailing like, set a trailing stop on the time frame, and let it like, let it do its thing. So in that way, you're not going to be like, red on that particular contract. You would like, get out with some gains. There is the trailing stop also. But what happens with the trailing stop is, like, yes, you can add your trailing stop on a contract. The issue with the trailing stop is market makers can actually see that trailing stop. And that's why more than often you'll hear people like, oh man, I had a trailing stop, I got stopped out, and then the stock like, ran up, or that stock continued like, going down. That's because market makers can see that, what you've said on your charts, and they will of course like, manipulate the stock to do like, what it needs to, so that you get like, shook out. Because remember, price does not move for a stock, price gets moved. You have to understand that price gets moved. And when you understand and accept that, you want to make sure that like, you basically show nothing to the market makers, and so that they cannot like, shake you out, or they cannot like, stop you out. Yes, you could potentially do a trailing stop, but personally I would not like, recommend it. It's happened to me too, and I'm talking from experience also. I have set a trailing stop 5%, 10% or so, and immediately within like, 5 or 10 minutes, I'll get stopped out, and then the stock will continue like, doing what it's supposed to do. So it's not something that I would recommend. I rather go in and put my values on the 15 minutes or the 30 minutes, and let the contract like, ride as much as possible, and get out with gains. So that's stop losses. So the 4 or 5 methods, right? As I said, like entry, as soon as you enter, let's say you jump the gun, you enter. If it reverses on you 10, 15, 20%, whatever your tolerance is, you do that. Otherwise, you keep your break even, as your entry. If the stock runs up a little bit but decides to pull back, your break even would be your next stop loss. Otherwise, the bottom of every candle or the top of every candle, depending upon whether you're playing calls or puts, you would just mark like that level. Heikinashi is great. You can use like Heikinashi too. So when you see the Heikinashi, like if you're in calls, you see as soon as it switches from green to red, get out. Like take your gains and walk away. Or the other method was what I showed you was like setting it on the 15 minutes or the 30 minutes or the 1 hour on your actual contracts itself.
Hey Hirsch, can you explain what is the Haganashi candle? I'm so confused on like what the difference is between a regular candle and a Haganashi
Okay.
candle.
So a regular candle is nothing but like but nothing but what a ticker does in that given like in a time frame, whether it's the 15 minutes or it's the 5 minutes or like or whatever time frame you actually choose, right? The Heikinashi, what the Heikinashi does is it aggregates a candle before it and it aggregates a candle after it, and it creates like the current candle. It's not a true representation of what the stock is currently, what level the stock is at, but it's just more of a confirmation for you to stay in a trade like longer than what you normally like would. It just aggregates certain candles, and that's what it provides on the screen. So I wouldn't time my entries on the Heikinashi. I would only use it in order to like gauge when it makes sense to exit. That's the only time I would use it, and the only time frame where the sweet spot is for the Heikinashi is the 15 minutes.
Okay, so if you go, can you go on SPY for a second, please?
Yeah.
So you're telling me you still want an exit right here?
Yeah, if you timed your entry, so let's say like like if I remove the Heikinashi, I just switch to like switch to the regular candle. Like let's say you decide to enter like calls over here. Yeah, like I mean, if SPY contracts are like expensive unless you're playing like zero DTEs, but even with zero DTEs, it would still make you like jittery. So let's say you see this big hammer over here, this particular candle, and you decide to enter like in a call. As soon as you see this red, more than likely you're going to get jittery. Maybe you might like get like shook out. So you're like, okay, do I hold? Do I stay? Yes, you'll hold over here. But then again, you see this red, you might land up like selling over here. But if you change this to Heikinashi, okay, look at it, it's straight like green at this point. So you would just continue like holding. You wouldn't even bother at this middle like this red that took place. You wouldn't even bother about it. You would continue holding up until you see an actual red candle like forming and closing at this point.
And would it close underneath that green candle and then that would be your stop loss, or you just see like a red candle?
Red candle and get out. If I'm using the Heikinashi, you would see a red candle and you would just get out.
Okay, gotcha. So yeah. All right, that answers my question. And is this just a day trade setup?
Heikinashi is best only for like in the day trades, because Heikinashi you're using on the 15 minutes. Heikinashi is not good for any other longer time frames. And the guy who made Heikinashi also actually said that you don't want to use the Heikinashi on the like larger time frames. You want to use it on the smaller time frames. It's ideally, there are many people that use it, but it does not make sense to use it on the larger time frames.
Gotcha. All right. Well, that answered my question. Thank you so much.
Sure.
I also have a question.
Yep.
How did you get your volume candles to be red and green?
Oh, this one.
Yeah.
There's a script. I can post it in the chat, but there's a script that can basically. I mean, there's a script that basically does this. Edit setting.
How useful is it?
What?
How useful is it? Like, does it make it more clear on the direction?
It just kind of gives you an idea of like what the like the buying or the selling is taking place. So you look at this candle over here, very minimal amount of red, and it's all like green. So like, okay, there's a lot of like buyers stepping in. Same thing with like with this guy. This kind of just gives you a gauge of like who is in control at that like given time. That's all it is.
All right.
Yeah, but it's a script. I can share it. While I'm over here, I think I can share it from here. Oh yeah, sure. Um,
Because I saw it a few weeks ago, and I was like searching the entire internet for it, and I couldn't find it.
and let me There you go. I've sent it in the chat. That's the volume study.
Thank you. I appreciate it.
Sure. Wait, sorry. Why isn't it good to use Heikinashi on the higher time frames? It's just not, Christina. It's just not made for the higher, like in the time frames, because what it does is Heikinashi aggregates candle before it and a candle after it, and then it does what what it's supposed to, it aggregates like multiple candles. It's not it's not an accurate representation of the current candle or what the ticker is currently doing. So that's why you don't want to use Heikinashi on the larger time frames, because it's going to be extremely skewed. It's going to be extremely skewed, with things. So see, this is like green, 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 some red over here. But then if you look at what it is on the regular, you see green, there's some red, red over here, red over here. So you see, you get skewed, it on the Heikinashi, you're not going to see a true accurate representation of what the ticker is actually doing. That's why it's better for day trades than actually swinging it and using it on larger time frames. 15 minutes is a sweet spot. Do you have a quick list of things you're looking for before you enter the trade? Volume higher, that 150K in 15 minutes, or pattern form, trend line bounce, SPY reversal just inside bar reversal. So I usually I when I mark my levels, I'm pretty much at that point of time waiting to waiting to see that level break and hold. And once it breaks and hold, let's say this is my break, this is somewhere over here is supposed to be my target. I just wait on the smaller time frames. I wait for a break and hold of that particular trigger. Then I enter my trade and write it to write it to whatever my target is. And then, as I said, I'll keep my stop losses, because obviously, yes, targets are meant to to show you where the stock or where you're supposed to take profits, but that does not necessarily mean the targets are always going to be hit. So when that happens, you want to be ready for it. So if it reverses, now you want to get out with maximum gains, and that's why you keep stop losses. Stop losses are not just meant to prevent you from losing money. If the position goes against you, stop losses are also meant to help you keep as much gains as possible from the position that you're in. So volume higher than that, do you perform volume also, right? If you understand price gets moved, you would see that when something is basically moving, okay, in a particular direction, when the larger time frames are indicating that buyers are in control, or or if the larger time frames are indicating that sellers are in control, you would see the volume according to that. It's a good gauge to kind of see whether people are buying or actually selling the stock. But personally, I don't use it as a gauge to enter a position. Once I enter, once my trigger breaks and holds and I enter a position, I'm keeping my stop losses such that no matter what happens, at worst comes to worst, I'm getting out at break even. I'm not getting out at a loss at all. Because you see, with SPY also, right, Chris? Just now, I was seeing messages from from Amre. He was saying okay, SPY is scary, something about being scary, and it's running up on zero volume. So that's the thing, right? You will see a lot of times something running up and the volume is not there. So so volume should not be necessarily be your indicator to tell you whether to enter a position or not. It should just be sort of a gauge to kind of tell you okay, what a stock is basically doing. Are buyers coming in? Are sellers stepping in? It should just be a sort of a gauge to to help you understand what is going on with that particular ticker. But it should not be an indicator for you to to enter or exit a position, because the stock is going to move. Price is going to continue to to move whether the volume is there or not. It's your job either to capture that move or to just sit on the sidelines and watch. Hope that makes sense.
Can you do a stop loss order on the active trader?
On the active trader, I know the active trader, but I've never traded the active trader, right? You could over here, you see this OCO, if you have an OCO bracket that once you enter a position, so my OCO bracket is 15% stop loss and gains at 20%. I had set this up a while back. So if I'm placing my order, I would select OCO and basically enter that position. So what will happen is if the position right off the bat goes against me at 15%, I get stopped out. Or if it's going in favor at 20%, it would it would kick me out and it would secure the gains for me. But as far as setting it the way that I did, specifically with the study, no, I don't think there's a way to to do it over here. You would have to go in the trade section and set it up over here to to sell your position on the 15 minutes or the 30 minutes or the hourly. You can set it by percentage. So if you're an active trader over here, you could say let's say you decide you want to sell over here, you could change and you could sell it according to according to your percentage, let's say 10% or 5%, like trail stop. You set your trail stop and you set it at let's say 10%. If it's at once it drops 10% your contract value, it'll stop you out, or it'll sell your position. You could do that over here. But if you want to do it in terms of the timing and all, then you'll have to do it the way I showed it to you in in the trade section.
Gotcha. Thank you.
Sure. Yeah, that's it. That's all I had, guys. If you have any questions, I'm here. Otherwise, hopefully the stop loss strategy help you and you'll use it. Stop losses are extremely important, as I said, especially in markets like this. On chop, on chop like this is what I mean by chop. Look at the week. Inside week, it's not able to break the lows of the previous day of the previous week, neither is it able to break the highs of the previous week, say AMD, another chop here. That's all it's doing, is just trading within within a range on the week, some of these tickers even on the month. So on chop like this, you absolutely want to have stop losses, or in general, because like I said, stop losses are not just meant to keep you from losing money. Stop losses are also meant to help you keep as much gains as possible. Just remember that.
Thanks, Harish. Great lesson.
Sure. Hey, thank you, Christina. Hope it helps.
Yeah, good lesson, Hurst. What was that